mode.
Good afternoon, everybody, and welcome to our webinar this afternoon on investing into and extracting out of private companies. My name is Andy Cowie. I'm a Business Development Director here at James Cooper, Creston, and I'm delighted to be joined today by one of our tax specialists, Mike Shearing. Hello, Mike.
Hi there. Good afternoon. Hi.
So for those of you that may or may not have attended one of these webinar type things before, we're just going to spend the next half hour going through the presentation. If there are any questions, then please do feel free to type those into the box. We will either take those as we go along, or alternatively we'll try and do a bit of a wash up at the end. At this point, I'm kind of hoping that you can all hear me. So just to make sure that the technology is working, I'm just going to launch a quick poll just to see whether or not how many of you own or intend to acquire shares in a company. So if we can, obviously people can hear me because the results are coming in. So thank you very much for that. We'll launch another couple of polls throughout the presentation just to break things up. But I say if there are any problems or indeed you can't hear us very well, then again, just please do let us know. So result of that poll is about 3/4 of you do indeed own or indeed are intending to acquire shares. Obviously, 1/4 of you not at this point in time, but still hope that you find this presentation of use. So with no more ado, I will pass you over to Mike to take us through the presentation.
Right. Thank you, Andy. Yeah. So good afternoon, everyone, and we're going to do this crazy thing of talking about this quite wide subject actually in just about half an hour on the basis that I could talk about tax all day, but I'm sure you've got better things to do. So as the title suggests, we're going to split this into two basic halves, which is the sort of investing into, getting money into the private company, and on the other half, actually getting it out at the end, out at the other end. And each of those, I'll sort of break that down into what are the different ways you can actually do those things, and then the tax aspects of those different things. So that's the way we're going to approach this. I've put at the end there one of our quaint tax sort of sayings, which is "Don't let the tax tail wag the commercial dog." Of course, I mean, some of us spend our days looking at tax and think it's quite important, but obviously any investment into a company or cash movement around it will depend on all the commercials and the legals and so on. But it's just nice, obviously, if we can make the tax work the best we can on that. Okay, so if we start off with thinking about investing into the company in the first place, so what are the different ways that your money can actually go into the company? Well, that in terms of shares or share capital, that might be obviously subscribing for new shares on the one hand, or buying existing shares from someone who already holds them. What are the different sorts of shares you might be looking at? Well, perhaps the most basic sort, obviously, ordinary shares, but on the other hand, some sort of shares with a preference, and that might be a preference to receive a dividend in advance of other people, or get your money back in some way in advance. Then once you've got your shares, obviously that does allow for a dividend stream, a flow, you hope, a nice flow of dividends out of the company. So that's clearly another way in which you hope to get money out. As I say, you can have different classes of shares, and you might do that for different reasons, partly to allow for dividends to be paid in different ways, and we'll come on to that in a little more detail. And also the reference to preference shares there. So that's the ways in which you might acquire shares and the different sorts of shares. Clearly, the main alternative to buying shares is to make simple loans into the company. That's the other obvious way of getting your money in. Those might just be very simple loans, might be just sort of secured on assets of the company, or it might be more complex forms of loans like loan notes or securities. Okay. So if that's the different ways of getting your money into shares or otherwise into the company. So just starting to think about the tax aspects of that, and again very much focusing on acquiring shares. Now, some of you may be aware of these reliefs. This is certainly the particular reliefs I'm going to talk about now is certainly something we do a lot of our time advising on, and that's the reliefs known as EIS or SEIS. So that's the Enterprise Investment Scheme or the Seed Enterprise Investment Scheme, which are some very attractive tax reliefs for subscribing for shares only, so definitely not acquiring some existing shares. So that's subscribing for shares, for new shares in a company. Now, what's the attraction of that? That is that on the amount of money you're actually investing into the company, you can get 30% of that in the case of the EIS reliefs, and 50% of that as tax relief from the amounts you subscribe. So very briefly, if you do invest, say, £10,000 into new shares, you can actually get £3,000 knocked off your tax bill under the one form of those reliefs, or in fact £5,000 under the SEIS relief. So you can see quite attractive in terms of on the way into acquiring the shares. And as we'll see when we think about the other end, looking forward, you can also sell your shares tax-free in certain circumstances. There are a number of different of conditions and so on, as you can imagine, to that, and anyone who knows about this release will know they need some quite detailed advice associated with them. One particular point I think here, just for our purposes, is that for both of those sets of reliefs you can't hold more than 30% of the company. So not really suitable if you are one of those people who owns 100% of your company or that sort of situation. But definitely if you're looking to invest in as a sort of a minority shareholder into another company, that you should look at that and make sure you look at that in advance of putting your money into the shares. So one little feature of the slides I'm putting here is that thing at the bottom saying think forward. As you'll see as we go on to a couple of other points here, it's really important to look ahead to the future when you're putting your money in, and just getting the terms of your investment right, and that way you should really set yourself up for some good tax relief.
Sorry, Mike. So the SEIS and the EIS, is there an easy differential between those, or is it just about the money invested in each of those schemes?
Yeah, no, that's a great question. So EIS is the sort of the base set of those reliefs, and it's been around for a good 20 years. SEIS is a more junior, more recent version of that, and in fact is designed for much more the sort of startup situation.
Okay.
And indeed, it's not available for companies which are more than 2 years old.
Gotcha.
So hence a better form of tax relief, but everything is at a much earlier stage in terms of the company.
Great, thanks.
We've got a couple of very good fact sheets for both of those, which are available on the website if you're interested in more detail on that. Okay. So moving on, also in terms of investing into the company and specifically around shares, this I suppose is more the situation where you're not, for one reason or other, available to take advantage of those EIS and SEIS reliefs we just talked about. So if you like, the more basic situation of acquiring shares in the company, and the tax system we have, bless it, does offer quite a wide variety of different sorts of reliefs. So just to focus on two very particular ones here. One is the thing called entrepreneurs relief, which again I think some of you will be quite familiar with. Another one, a newer one, which has only really just been around, I think I'm right in saying, for about the last year. Both of these allow for no tax relief on when you're actually acquiring the shares in the first place, but will lead to a 10% capital gains tax rate on when you sell the shares later instead of the standard 20%. So again, it's about looking forward to what you hope will happen when you sell those shares, and as I say in a moment, just sort of planning carefully in the terms of the investment you're actually making. So as I said, both of those can lead to that quite nice 10% capital gains tax rate when you sell. Either of them can be for shares you actually subscribe or you buy from an existing shareholder. But the almost contrasting sorts of reliefs in a way. So entrepreneurs relief, you have to be either an employee or director of the company. You have to hold at least 5% of the shares in the company, and in fact those conditions need to be around for the last 12 months before you sell. So you can see you need to be getting those conditions right in order to benefit from the better tax rate when you eventually sell. I suppose just very briefly on that question about the 5% is measured in terms of having to have 5% of the votes of all the shareholders, but also 5% of, I'm going to call it the nominal value of all the shares in the company. And that does actually allow for a little more flexibility than you might think. So you don't always need to sort of, if you're just below 4% in terms of things like rights to dividends or rights to sales proceeds, there is a bit of flexibility in acquiring that relief otherwise. So they say the other side of that is the newer thing called investors relief, and in some couple of ways it's the opposite of entrepreneurs relief, in which you cannot be an employee or director. It's kind of designed for what you might call passive investors. So you can't be an employee or director. There's no percentage holding requirement in terms of the number of shares you've got, but you do have to hold those shares for at least 3 years, the 10% rate. So quite nice things there in terms of this aspect of what capital gains you'll make when you eventually sell the shares, you hope. But again, you can see you almost need to sort of jump either way. You know, are you going to be an employee or director, or aren't you? So it's just a question of planning around that. Okay. So that was a very brief look at the sort of release we're thinking about on the way into shares. What are the formats we talked about of getting your money into the company? Well, the main other area, of course, is lending into the company. And of course, loans, unlike shares, don't allow for capital growth. It's just a question of being able to get your principal back and probably a bit of interest on the loan you've made. But on the other hand, unlike shares, that's generally easier, of course, to get your money out of the company. And of course, you might have a mix of both shares and loans into any particular company you're involved with. So, as I said, that could either be a very simple loan, or it could be a more sort of secured form of loan, in particular, that gives you more legal protections about when and how your loan might be repaid. Yet another thing about thinking forward, in particular, if we're talking about a situation where you're lending into a company where you have really quite sort of serious involvement, you might even own the whole company or whatever, and in the early days of financing the company, quite a simple little approach in a way, which is to think about instead of a situation where you were, say, going to be paid a salary or director's fees. If you think about it, if you were then paid that salary or director's payment, then it might just go through the payroll and be taxed at quite high rates of pay-as-you-earn NICs. If you more just think about actually just repaying part of the loan to yourself as and when you need amounts out of the company, then clearly you're not actually being paid salary and so on. So that's just quite a simple little trick to think about in terms of cash flow in and out of the company.
Perfect. Thanks, Mike. That kind of covers what we wanted to very much with investing into the company. As I say, a lot of things to consider when you are doing this. Actually, let's just launch another poll just to prove that actually tax people are human as well. Why not? Who do you think is going to win the Euros?
Yeah.
Not a lot of love for Portugal at this point in time, people. Okay, so it's very much looking like none of you think Portugal are going to win it. 44% France and 56% Germany, so that's looking like 100% of you are thinking that the winner is going to come from this evening's semi-final. Anyway, enough of this silliness. Let's move on to how we're getting cash out of private companies.
That's all very useful. I think we're off to the bookies.
I think so.
Okay, so racing along then into thinking about how that money comes out of the company. We hope that the company's made good profits and money will start to flow out to the deserving shareholders. So how do we think about money coming out from the company or from your shareholding? Along the way, clearly on shares, there's the dividends that can come out. You might, on the other hand, be at a point of selling your shares. Now, what that could be, clearly selling the whole company, which is the sort of the major event, or just a sell of your shareholding to maybe an existing shareholder. It could be the company itself buying back shares, which is clearly a concept of a way of the company paying you money for your shares. You might have a sort of slightly more complicated transaction of a new company being put on top of the existing company, and that can allow for funds to move. Or more complicated still, I suppose, where you've got a company or a group of companies, and those are reorganized, split up, demerged in some ways, and again that can release value or funds back to the shareholders. Then again, moving away from shares, clearly the loans you had previously put in can be repaid, and we've talked a little about that. Conversely, you could be talking about the company making a loan to its shareholders or directors, and we'll touch on that. And then not to forget, of course, the fact you might actually receive a salary from your or in consulting fees from your work for the company. And then finally, pension contributions is clearly a way of money moving from the company to your essentially to your control, or certainly to your pension scheme. Okay, so again, if we now start to just briefly look at the tax implications of that list of things. An area where tax people spend a bit of their time thinking about is that whole sort of mix of, do you receive dividends or salaries? And you can really get quite scientific on this if you choose. The fact is, salaries are not, on the face of it, the best tax way of getting money out of the company, because the highest joint income tax and national insurance contributions rate these days is effectively 47% when you add those two different charges together. Whereas the highest dividend rate these days, after some changes we've had in that area, is now 38.1%. So you can sort of see straight away there that it's not too difficult to see that dividends are generally still more attractive. As I say, there are ways in which you can sort of try and get to a very scientific calculation that's exactly the best rate for any individual and individual company, given that, for instance, the first £5,000 that any person receives of dividends is tax-free these days. So, as I say, you can be really quite scientific about this, but to do those calculations can be quite complicated. What other ways can we look at? So repayment of loans by the company, if you had previously made loans to it, as we saw earlier on, clearly just the company repaying your loans is no tax event at all. You're just getting your money back. So that's really not to be forgotten, that approach. And then the other side of that, as we said, the company actually making you a loan as a shareholder or director, that would need to be thought about really quite carefully. Of course, I'm sure any finance director would think very carefully about that before that happened, but it does definitely happen. Anyone who works for, who has involvement with a company which is what we call a close company, which effectively is owned by 5 or fewer of its shareholders, you may be aware of a particular tax charge that happens where a company does lend to its shareholders, and in that situation, the company actually has to suffer a tax charge. Now, there's been a very recent change on that. Previously, where a close company made a loan in that situation, it would have to then pay 25% of that amount lent to the revenue. That would then be repaid actually from the revenue back to the company once the loan overall is repaid. That rate has just gone up now to 32.5%. As I say, this is all just tax charges that happen for these closely held companies. If you've got a company where there's a wide number of shareholders and no particular small group of people controlling the company, then that loan situation may still be worth looking at, and there are a couple of other tax points to watch on that. And then another way we mentioned of funds, another way of funds coming out from the company is sort of pension contributions. Now, as you probably know, that in itself is a subject in its own right, but again, not to be forgotten, particularly in the light of the relaxations to what you can do with pension funds, which came in again in the last year or so. Pension contributions that the company can make are limited essentially to $40,000 a year without tax charge to you. Once those contributions have gone from the company to your pension scheme, and you're over the age of 55, then these days you can then start to pull out lump sums of whatever amount you like out of your pension scheme, but only 25% of that basically will be tax-free. But again, not to be forgotten in terms of the cash flows we're talking about.
Indeed. Well, while we're talking about pensions, I mean, we obviously try to put on webinars that our clients and contacts actually want and will get benefit from. So just on the just thinking forward and potentially other webinars that we are looking at, is the whole idea about pension schemes and how it can be used tax efficiently for removing funds from the company something that people actually understand and maybe would feel of use as running something in the future? Obviously, we're not an IFA business, but we'll be happy to try and get somebody in to present on this. Should it be worthwhile? No, thank you very much for that. It's looking like, yeah, 60% actually probably don't actually understand the ins and outs of the pension scheme. And we'll look to run something like that at a future date. So yeah, thank you for your feedback.
That's interesting. We were speculating as to what that outcome of that would be. I was worried it'd be a lot higher actually. So 60% of only 60% of people not fully understanding their pension scheme doesn't seem. Yeah, great. Okay, so that was pension contributions, and then the the final area before we move on to any questions and so on is sort of, if you like, where we came in a way, and that's the question of when you're selling your shares or disposing of your shares in some way. So we said if you had been able to claim those nice tax reliefs when you invested called EIS and SEIS, then you could be looking at a 0% rate if you're selling after more than 3 years. We're looking at entrepreneurs relief, that capital gains tax rate of 10% if you'd held the shares for 1 year, and then similarly 10% for investors relief if you'd held them for 3 years. So that, very much underlines this point of if you've got things in the right order, done the right sort of thing when you acquired the shares, when you're holding the shares, then things can look good when you're selling. The situation of the company buying back shares, which we mentioned, this can be a slightly confusing area to some people. People can think that's a great way of cashing in your shares as a capital gain, and indeed the first part of that is true. It can be a very good way of cashing in your shares if the company is happy to buy them. But in tax terms, by default, that is actually just taxed at dividend rates. So there could be quite a distance between what you might hope for as a 0 or 10% capital gains tax rate or being taxed at a dividend rate. There are ways in which that transaction can be treated as what we would call capital and taxed at capital gains tax rates, but again that needs a lot of careful looking at in advance of the company actually doing that. Then there are these other couple of slightly more complex ways of if you like, moving company shares around. One is putting a new parent company on top of the existing company, and you might be doing that for all sorts of other organizational or commercial reasons. But that in effect, what you've got there is the new holding company acquiring all the shares in the existing company, and to do that, it may well pay cash for that. So that could be a way in which cash can come out. Needless to say, some detailed tax points to look at on that. Or finally, the more complex splitting up of a group of companies, which again you're much more likely to be doing for commercial reasons than tax reasons. But similarly, that can because that can break up a group of companies or division of a company into different parts, that can clearly allow and free up one particular bit of the business for a sale, in that allowing you to keep the rest of the business under your current ownership. That, I think, is about that on a very rapid jump through.
Fantastic. Then I say, 30 minutes is not a lot to actually get through everything that you wanted to do. No. We have actually had a couple of questions. Mike, is the option of self-administered pension scheme still available, especially to buy commercial property?
I'm going to be really careful on that because the whole, as I said, the whole area of pensions is quite a special subject in itself. I'm going to stick my neck out and say I believe that is still able to be looked at. We'll be very happy to sort of pick that up with you as a separate question, if that's okay.
Yeah, that's fine.
Whoever asked that. And we had another question on sort of extracting funds from the company. That's an interesting aspect. I suppose I've spoken really almost exclusively, haven't I, about cash movements, and which cash is always nice to have. But someone's raised the question of other sort of forms of benefits, childcare vouchers, for instance, and there is a whole area of benefits that the company can provide in that way. That's absolutely a very good point. Childcare vouchers are still there, and there are a number of tax reliefs and also reliefs from national insurance contributions on childcare vouchers. So that's definitely something worth looking at.
Fantastic.
Yeah.
Obviously, it's happy to take any more questions if anybody has anybody. Mike, thank you very, very much. I think this was very much a quick trot through some of the main ideas of how you can invest and extract out of the private company. I would like to point out that, of course, it's very much down to personal circumstances, and of course outline the usual disclaimer that our presentation is very much used for information purposes only. Nothing we've said today should be taken as advice. Of course, if you would like more advice on anything that we have gone through, then of course please do contact probably Mike. I'm pretty useless on that sort of thing, I must admit. Mike is very much your man. So thank you so much, everybody, for joining, and as I say, I hope you got something out of it. Mike, thank you so much. We will forward everybody a copy of these seminar slides and recording, and say if we can be of any help, or if you'd like to know anything in more detail with regards to what we have gone through today, then please do not hesitate to contact us. Thank you so much for your time.
Thank you very much.
Thank you.